On July 24th, China executed a synchronized shutdown of its retail paper gold trade for citizens trading through banks. Access has been switched off. The Industrial Commercial Bank of China, the Postal Savings Bank, and Ping An Bank, three of the country's largest financial pillars, are executing this shutdown in synchronization. The official narrative centers on volatility. After spot gold hit record highs earlier this year, the central bank claimed these restrictions were necessary to protect retail investors from sharp price corrections. To see how they force this exit, we must look at the baseline for margin trading. Usually, an investor provides a small percentage of collateral to borrow capital and place a larger bet. Standard gold trading often requires as little as 10% collateral. This mandate pushes that requirement to 140%. This is forced over-collateralization. Investors are now required to post significantly more capital than the nominal value of the gold they are actually trading. At 140% margin, the trade is no longer a tool for leverage. It is a mechanism designed to drain market liquidity and bring paper trading to a halt. While paper gold access is being severed, physical bullion ownership is completely untouched. You can still buy, sell, and hold the physical metal by preserving physical ownership while shutting down. Papertron tracks the regulatory focus moves from retail protection to the underlying mechanics of the trade. This is the prerequisite phase of a larger strategy. By eliminating paper speculation, China is clearing the path for real price discovery through physical settlement, creating an alternative financial system outside the US dollar. The Western financial architecture, centered on London and New York, operates largely on cash-settled claims, rather than the movement of physical bars. This creates rehypothecation. A single gold bar serves as collateral for multiple paper claims. The paper supply inflates while the actual metal remains unchanged. Because contracts are cash-settled, the system rarely faces physical demand. Flooding the market with paper mathematically suppresses the physical price. Analysts look for the suppression by measuring the price divergence, the spread between the physical SPA price and the paper derivative. In the silver markets, we have seen physical premiums hit 40% during periods of high demand. When the spread widens, it indicates that the market is willing to pay more for the metal than for the paper promise. To find the actual market value of a reserve asset, a nation must first remove the influence of the paper casino. When paper markets suppress value, central banks react by selling paper claims and accumulating physical metal. In the first quarter of this year, central banks purchased 244 tons of physical gold. This represents the strongest start on record, the World Gold Council notes. These numbers include undisclosed purchases, pointing to a massive shadow accumulation that banks are not reporting. These gold purchases are being funded by the systematic sell-off of US sovereign debt. For 5 decades, 4 nations recycled their extra dollars into US Treasuries to earn interest. That entire model is now completely in reverse, as central banks systematically rotate their reserves into non-yielding physical gold. Trading a yield-bearing US Treasury for physical gold is a strategic move to reduce dollar dependence and move toward a multipolar financial system. China's answer to Western paper pricing is the Shanghai Gold Exchange. Unlike the Western exchanges, Shanghai requires physical delivery on its trades, ensuring the price is tied to actual metal rather than paper leverage. Because of mainland capital controls, Hong Kong serves as the essential gateway for international partners to access this physical delivery market. To support this shift, Hong Kong is expanding its physical vault capacity tenfold, moving from 200 tons to over 2,000 tons. By linking commodity trades to physical gold delivery, China is creating a tangible anchor for the yuan in global trade. As the physical gold infrastructure expands in the East, US institutions are facing a direct challenge to the dollar-based settlement system. The United States' potential countermove lies in the dormant assets currently held on the Treasury's balance sheet. Official figures state the US holds roughly 8,000 tons of gold. However, an accounting rule from the Nixon era means this gold is still valued on the books at an obsolete 1973 price of $42 per ounce. This accounting quirk hides nearly $1 trillion in value, masking the actual collateral power of the US government. By updating the statutory price of gold to current market levels, the Treasury P instantly see the value of its reserves skyrocket to over $1 trillion. This creates immediate book value for the government without the need to issue new Treasury bonds. Some economists are now proposing a 50-year Treasury bond that is partially backed by or redeemable in physical gold. This would create a parallel sovereign anchor to China's strategy, aiming to restore global trust in the dollar through tangible collateral. The competition for monetary control is moving toward a system centered on the physical collateralization of sovereign debt.